Kev, now we're gonna do the Thanksgiving listener Q&A.
It's our first. It should be fun. I'm looking forward to it.
All right, so our listeners had an opportunity over the last week, whether on Twitter or by emailing us, to send us questions, and so let's jump right into it, and let's just see the first. So the question, Kev, the first one our listeners asked: How many listeners have you scared away with the pictures like these?
Love those. You mean that they are banner ad? I actually worry about that sometimes. I definitely have scared away a few. There's no doubt that some people have a look at it and they feel like it's been burned into their eyes and they have to ask for surgery to get it burned out of their eyes. But it's something that I enjoy. It's a lot of fun, and
You're loving torturing people, right?
It's not going to change. That's all I'm going to say. It's not going to change.
Kevin, you're going to have to pay for my vision care.
That's right.
All right. So let's
Hey,
get
one second before I should tell you. These are the ones that I feel are safe enough to come and to make it to publication. Imagine the ones I have a whole database. People often ask me like, where do you get all these pictures? I save everything. I have tens of thousands of images. Imagine the ones that I can't use.
I couldn't. I'm starting to go somewhere with my mind, but
Yeah.
I'm just not going to say anything at all. All right. To a more serious question. The question was, what experiences and skills do you guys think are required before starting a fund, especially from the perspective from someone who hasn't yet graduated from university?
Okay, well, I obviously I'm no expert, but I will say this, that people think that having good market calls are all that matter for starting a fund or marketing a fund. The reality is that there's three different parts of managing money. One of them is obviously the managing the money. The other part is marketing. And then there's a whole other part of administration. And too often people underestimate how much the marketing is going to take out of their time. I have a lot of buddies who went and started hedge funds and they say, listen, I don't even get a chance to go watch the market anymore. I'm too busy pitching all the time. And this is why it is so difficult. And it's those three skill sets that kind of combine. And it's one of the reasons that a lot of times people join forces with someone else, because to do it all on your own is difficult. Not only that, those three skill sets are very different, and it's very rare that you'll get an individual that has all three.
Right. And starting a fund in itself, like there's managing money. There's you could be a prop trader. There's all sorts of ways to put in there. But a fund is something where you're soliciting other people's money and undertaking the financial. The compliance and everything that is involved with independently starting to manage other people's money. There's so many hurdles, so much paperwork, so much everything. Just the way the securities commissions just are up your wazoo about every little detail. It's a whole other element, right?
And you see even big time fund managers like I think David Einhorn and what's the guy that fought with Carl Icahn that I don't like. I can never remember his name. The one that got into a big the one that got caught short that stock.
Ackman.
I think both of those guys have said, I'm returning to focusing solely on picking stocks because I'm spending too much time on the business end of it. And you have to be careful because before you turn around, you won't be looking at stocks and you won't be doing what you truly love and you won't be managing money. You'll be just running a business. Okay,
so one last thing, just because this was a perspective of a young guy or girl that is in school, and they're obviously love the idea of getting into that side. And so like when you're starting, like if you're someone that's like 22, 25 years old in school, I mean, what path do you take to pursuing this?
Well, they have to go and get some experience at an existing fund of some sort and learn those different skills. But at the end of the day, if you don't know how to manage money, all those other skills won't matter because you won't be a fund manager.
Yeah.
So the two other ones are something that you need to be able to do to be successful, but the one is essential, and that is the fund management. Okay, Patrick, I'm going to give you the next question. When does the market start discounting the 2020 election in earnest? What effects do you think a wealth tax, capital gains taxes, ordinary income, and the end of unrealized capital gains would have on the market? So that's kind of 2 points. Let's start with the
That's
first one. When does the market start discounting the 2020 election in earnest?
Well, I think that to one degree or another, it's already and all known information to one man or another is always being discounted. But the probabilities are always that an incumbent president has the probability of winning. At least a lot of history has that on there, and so I think that the market more or less. Is probably already discounting a Trump victory. So I think that it would actually be the part that is not being discounted would be if the Democrats really actually looked like they were going to take this for some way, and that's probably not being fully priced in. So I think that if Trump if it looks like in the polls that Trump is going to be reelected, I think a lot of this has already been baked in the cake. What's your take on that?
I'm not sure, actually. I didn't expect that answer from you. I would say that even though incumbents are often elected, I would say that Trump, like in most cases, that being Trump, is a different ball of wax, and I'm not sure you're correct on that. I think that the market is looking past the risks of a Democratic kind of win going forward, and so I am also struggling with this question about when do those risks start to get priced in, and whether it is actually in the market as much as you think. I actually had a interesting kind of what was an interview between Ray Dalio and Paul Tudor Jones, and Paul Tudor Jones talked about what would happen to the market if Elizabeth Warren was elected. And he was of the opinion that it would go down, the S&P would drop 1,000 S&P points.
Yeah.
And his argument was kind of down, into. He said if you risk adjust the probabilities of those Democrats winning, you could therefore argue that if we do get a situation where Trump wins, that the market actually has to be a lot higher. Because
Really?
because if you think about it, if we know that the Democrats winning, let's just say on average it costs us, there's a 750 point loss, and we have a situation where, let's say, it's even up right now. That means on the other side of the equation, for it to be risk adjusted, it means it has to be a 750 point rally. Now, I don't know if I buy that. I'm going to write a blog about it because I actually think it's an interesting topic. Let's go on to the next one. What do you think of the effect of a wealth tax, capital gains tax as ordinary income, and the end of unrealized capital gains would have on the market?
Well, definitely. I mean, if you get Elizabeth Warren or something like that coming in there, that has to be a little bit scary for the markets. And so I think even just seeing which Democratic candidate is going to actually win the ticket is actually going to play in huge. I can't imagine the markets liking anything that involves taking away something that is moving the markets forward in terms of anything that's raising taxes.
Do you think it's like a Leon Cooperman style 1,000-point S&P move? Like he said something, and it was very hyperbolic about how far it was going to head it down. What do you think?
Yeah, but we heard the same thing from Mark Cuban about Trump. Like, you know what? You're always going to have
a difficult night that night when he won.
But on balance, I think that these guys come out there with these boogeyman things to try to sway the political opinion, but what they say and what actually happens are two very different things. I think that's an overshoot.
Okay, so here's what I'll tell you what I'm worried about. Although I think a wealth tax, capital gains tax as ordinary income, or the end of unrealized capital gains would hurt the market, I think what would hurt the market a lot more than that is an obsession by the Democrats to balance the budget. And I'm actually more worried about them raising taxes than I am about them doing those other things on the whole to the economy. Now, that's just me, and I think different things affect the market, but I think that one of the reasons that the market's done well is because the U.S. is running a deficit of 4.5% of GDP, and if we get a situation where they come and the Democrats think that they have to go and actually balance the budget, I think we're going to get a situation just like Germany. Germany has a surplus budget, but their economy is struggling and their stock market's stinking. So just be careful what you're asking for, because I think that is actually more of a worry than the wealth tax, capital gains tax, or the unrealized capital gains. Okay.
All right. So let me get to the next question here. So the question here for us is, what will be the tell when QE and rates are not effective?
Well, I I'm already at the the opinion that QE might not already be effective. Like, what are we trying to accomplish with QE is what you have to ask yourself. And if we're trying to accomplish getting the economy going, then I think
That,
that it's never been effective. So, what are the tell that QE and rates are not effective? Well, those are two different things because rates, meaning that you could lower rates and cause the economy to pick up. There's no doubt that we've got in a situation where monetary policy in all of its forms is becoming increasingly ineffective, right? And
so
you could just see even by, let's go back to Germany. I loved using the European example because the Europeans have taken things to such extreme. They've hit a point where monetary policy is not only not effective at stimulating their economy. I would argue that as they lower rates and try to put more monetary stimulus into their economy, they actually have the perverse effect of slowing their economy. So,
so
what would be the tell? That maybe it's that we all start speaking French. I'm not sure. um,
So
but
listen, okay, let me take this a little direction. So when we were in Chicago, we were having the bull bond bear debate, and I was arguing the whole financial repression argument, and a lot of in order for you to maintain very low interest rates, somebody has to be a buyer of bonds when governments need money. There you go. You're giving me that face. But listen, the bottom line is that can you say it's ineffective? I mean, ultimately, yes. Let's be realistic. If they were not buyers in this market, interest rates would be much higher.
oh my God, really? You honestly believe that? Like, seriously, you believe that?
Well, now I'm questioning it ever since.
You honestly think that the government is actually keeping interest rates limited by their bond purchases?
Well, I mean, they are buying.
Okay, so how do you explain the fact that Stanley Druckenmiller and I agree on this fact that when the government comes in and does QE in its earnest, the bond market actually backs up? Often what you'll see
Because of inflation fears.
right. Okay, so QE is not what's keeping interest rates constrained.
But
No,
no.
I'm going to take the other side of that trade, but that's a
I don't know.
far-ranging discussion. But
All right,
I would say, how do you tell when QE and rates are not effective? I think we're already there. Is the truth of the matter, and the fact is that we've got a situation where we are having increasingly the central banks are becoming increasingly impotent to fix it with lower rates,
Right.
and I think we're there. So now let's go on to the next question, Patrick.
All right. So, do you think that the Fed will go as far as the Bank of Japan buying risk assets and to shore up the markets, or what's
Okay,
next?
so this is again an abomination of monetary policy. And I remember I threw up in my mouth when I heard I can't remember which guy did it. One big money manager got on CNBC or Bloomberg and started talking about that the ECB should stop buying bonds, and what they should really do is start buying the equities. And that's like, no, that is not what they need. We do not need central banks buying equities or risk assets. We need
Okay,
demand
what you believe, and what
Okay.
they will do are two different things.
Okay.
But the question is, do
I
you believe they will?
Will the Fed go as far as the BOJ buying risk assets? No, they will not. I do not believe that we are going to go to that kind of extreme. And here's why. I think we've already turned the corner in realizing that extreme central bank policies do not help the real economy. And that you're going to get a situation where all you do is increase wealth inequality. You're just going to send financial assets to the moon without really creating any actual underlying economic activity. I don't see it happening. I certainly hope it doesn't happen. And I'm hopeful that they're going to wake up and realize that central banks can't solve the problem. It has to be fiscal. Okay.
All right, let's move on.
So here, let's go on. Apart from shipping and uranium, do you see any commodity sectors that could be facing supply shortages over the coming years?
Yes. And actually, but it has to be even broader, which is essentially that the entire commodity complex has been in a bear market for an extended period of time. And it's not original to me. I first heard it from Rick Rule. It's that truism that every bull market is the author of a bear market, and every bear market is the author of a bull market. And when you have an extended period where there's a massive bear market, there's supply destruction. And like a great example of that was when we had a number of our guests come on and we talked, let's say, copper, and the idea that, well, listen, do you want to create a green economy that runs on electricity? But how do you build the infrastructure? You need a huge amount of copper. And I remember hearing Marin Katusa say, I don't know whether this is factually true or not, but there hasn't been a
Marin
new.
said it must be true.
It must be true, but it probably it is. But we have seen that there has not been a new major copper mine put into production in like a decade. And so they're just continuously extracting this from the ground, and the prices are so depressed that they're at these levels that it's just not economical for geologists, or no, they can't, nor can they find the money to fund these projects to go and put new projects in, and eventually it's going to come to roost. And whether it's copper, whether it's all the basic materials, there's a point where this will turn and the prices have to rise. It'll be inflationary, and you're going to win at that moment with your inflation narrative. But there will be a point where we're going to see a huge run in commodities because of what's happened, and I think it's very broad. You're going to see it in a whole array of different commodities in the markets. How about you?
Well, I agree with a lot of that. Like, what's the line? What's the best cure for low prices? Low prices. Like that's.
Yeah.
Well, it's kind of an auxiliary of Rick
Yeah.
Rule's kind of comment. I would say that I think energy will be the biggest ones that get squeezed because it's fundamental to so many parts of our economy. It's so the demand for energy is so inelastic in that if we get a situation where we don't get the supply response that we're expecting, then it could the price movement could be huge. So I actually, even though everyone tells me that there's crude oil for miles and miles and miles, um, I think you're going to be surprised.
What was that stat? One of our guests said it was something like 6 barrels are being used for every one that's being discovered.
Yeah, and so I think that there's two big kind of oil fields coming on. I think there's one off Norway and then some other South American country in 2020. We're getting some still the supply is increasing, but after that, there's not a lot there coming on. And if we get a situation where the world economy starts growing and we're not all using Elon Musk's batteries to power everyone, then we could get a situation where the demand far outstrips the supply, and there's a huge move in those commodities. Anyways, I'm in your camp, which means that we're probably going to see years of deflation in commodities.
There
Okay.
you go. All right, so let's move on. And so the first part of the question from one of our listeners is, what is the best way to trade the upcoming MMT?
Well, I like his style already. The upcoming, he's accepted it. uh, I've gone over this before. I still think inflation break-evens are the absolute best way to trade it because I think that we're going to get a situation where inflation increases, and yes, you can trade gold and other things as inflation hedges, but those again are always second derivatives of inflation. And to me, inflation kind of break-evens, meaning
How does a retail investor participate in inflation break-evens? Is there? Do you know of an ETF that does it?
It's not easy. There is one RINF, which is a listed 30-year break even. It's not very liquid. I wouldn't recommend it. It's something to look at. I still think that a retail investor should take the time and learn how to do it and actually figure out how to buy the tips and short the future or short the underlying, because at the end of the day, it's not going to move huge. It's not going to be something that's like a shipping stock that's going to double or triple or even quadruple in your face. It's going to be something that's just on the margin is grinding higher. But I also think at the same time, that's why it's a low risk bet and it's a better trade for me. So I would actually rather own inflation break evens on a levered basis than a second derivative of inflation on like an even basis.
Right. And so the second part of the question is, are there any books or resources that you would recommend to learn macro and options?
Well, options is easy. You should go read the Natenberg book. I can't remember the name of it. Do you know? I should go get I think it's Sheldon Natenberg. He's the kind of the godfather of it. It's Option Volatility and Pricing by Sheldon Natenberg. Just go spend the time, buy that one. In terms of on the macro side, I always recommend that people go and listen to Ray Dalio. I think Ray Dalio has a great way of explaining the fundamental kind of underpinnings of how an economy works, and I would, steer them towards his site and his books. And then from there, I think that there's, I think if you actually didn't come from an environment where you've already been brainwashed with the ideas that my young friend across the table from me here, Patrick Serezna, thinks about how the world economy works and how we're going to have deflation, I think you're actually at a huge advantage because you could get a situation where you can go read the MMT guys like Warren Mosler or Randall Ray and keep an open mind about it and to get a situation where you're learning how a modern fiat monetary system works. And I'll repeat this again. MMT, you should divide it up into two parts. You should divide it up into the descriptive part that explains how a modern, fiat monetary system works, and then the prescriptive part, which is basically the political decisions we as a society take based upon those things. And too many people get so hung up on the political decisions and all that part of it, they miss the huge kind of edges that can be occurred by understanding the descriptive part. I can't tell you, Patrick, the number of strategists, economists out there that are actually MMT consistent and just don't call themselves MMTers. And it's because they understand how it works and they understand the modern monetary system, and they are using that. Anyways, that's my lecture for today. So, Patrick, what do you specifically like about REMX, Rare Earth Metals ETF? And are you worried about the huge China exposure?
Well, you know what? I guess the big trap here is that I'm by no means an expert on rare earths.
You don't even play one on TV.
No.
But you did stay at a Holiday Inn Express last night.
but I really was just I was playing it more on the idea of the whole resource sector being so incredibly oversold, and generally I felt that as all commodities turn, that rare earths had the opportunity from such an incredibly oversold state to have lots of mean reversion where they could head higher. But as you were saying, what's your saying about rare earths?
The trouble about rare earths is that they're not so rare.
Exactly. Exactly. But it certainly is concerning. The large portion of the fund that is exposed to China, but I mean generally it is actually there's a lot of environmental issues with producing a lot of rare earths in the developed markets. You really have to, a lot of it because of the environmental restrictions have to be done in emerging markets, right?
Where they can ignore those environmental restrictions?
Well, I'm not.
Okay, so we're trying to save the world with
I'm just saying, but I'm talking about regulations. I mean, when you're trying to get the stuff produced, you can't get it by in the system in the developed market. Oh my God, unbelievable! You're like busting my balls on this. The point is, it is concerning that there is there is that much of a component.
Let's face it. You just like the chart. Let's pull up the chart. What does it look like?
It's one of those ugly from top left to bottom right kind of.
Oh, it keeps melting.
Yeah.
Well, you know what? Why did we let this question make it into the group? Actually, I put it in there on purpose. Okay, so there we go.
Okay, let's. So when looking
it's not so bad. It's actually.
So it's still very close to its all-time low, and I mean this went from $120 down to 12.
Well,
90%.
It's cheap.
Down. It's
okay.
That's all we can say.
It's cheap. Let's go on to the next one, and I'm going to take this one.
All right.
Is core PCE inflation a good metric? What are its flaws? Is it oversensitive to certain categories and undersensitive to others? What do you think, Patrick?
I wasn't listening to the question when I was distracted.
Okay, I'll take it.
No.
Core,
But listen.
core PCE, it's not a good metric. Like the reality is
No.
that most inflation is terrible because
Oh,
it's
CPI is the worst.
well, yeah, but what else are you gonna do? The one thing I will say that's interesting is that have you ever seen this Google million prices or something? There's some crazy algorithm that the Google propeller heads made, and they basically track in real time a million prices, or probably more than a million
And
prices, and it actually follows the reported inflation much better than you would have expected. Especially since everyone complains and says about the shadow stats, and if you use the old version of kind of inflation, that we would have 6% inflation and all this crap, and the hedonics, is that how I say it? Hedonics? I'm not sure how I say it, but this idea that you can take when the price of your store line goes up, you can replace it with pork is I think it's kind of ridiculous. Not only that, like when your pork goes up and you're replacing it with some vegan crap, like what do you like? That's not going to happen.
yeah,
So the reality is that
the substitution rules you're talking about.
yeah, I just think it's, and then the thing that really bothers me is the idea of a car or even a computer. So you go buy yourself a new, well, Patrick, used to drive an old Hummer, and they don't make them anymore. So I can't use this example for Patrick, but let's just say for a regular person, they go buy a new car and it's got 20% more horsepower, and all of a sudden they say, well, it's got to be 20% better. And I'm like, well, geez, like I don't know about you, but like it's not getting me there 20% faster. It's not 20% more reliable. It might be a little more reliable, but on the whole, or the computer, like your iPad, it's twice as fast, so it's twice as good. Bullshit. Like it's just crap. Like so. No doubt about it that the inflation is underreported. I 100% agree. I guess all I would say to this is that the PCE inflation is what central bankers are watching. So that's what you have to watch, and that's what you have to be sensitive to.
It's interesting. I was taking that. I was looking at all that stuff that Russell Napier and his program were when he was in Toronto, and they were doing hundreds of years of data and using the CPI, and I was asking all of the profs and Russell about inflation and CPI. And it's like, well, it's not a great measure, is it? And they say no, but it's the only thing we have that has the historical data that far back, and so a lot of the analysis that comes from it is just simply because it's been tracked for so long that it becomes the basis for all the research and work, right?
Right.
Anyway,
so that the question. It's obviously we're not economists, so we don't know like the flaws of PCE versus CPI. On the whole, we just kind of feel like they're all understated, and that you should be more sensitive about what they're watching than the specifics of getting into the nitty gritty of each and every.
For sure. So let's move on, and let's take a more complicated topic of gamma. So I had two listeners write me in questions. And so both of them actually are very much on the same line. So I'll read both of them separately, but we'll answer them all as one because we're just we'll tackle this. And so the first one is, I understand delta hedging, but want to know how a market maker can be long gamma, because they have always assumed that option dealers mostly sell calls and puts to clients more so than clients sell to them. So that was the first question. The second one is, I'm just learning about option deltas. So maybe I've got this wrong, but it seems that gamma is greatest at the strike price as an option moves in the money at expiration. Since institutions are on balance premium sellers, they will do what they need to keep that from happening. Amazingly, you and others are implying that they're able to execute on the market manipulation, and that is something to be expected in normal course of things. So they're talking obviously about all of this gamma, and so I'm going to paraphrase or rephrase a lot of this. The first interpretation that many have is that the dealers are sellers and subsequently the retail is the net buyer. But I can't think of a better person to have this conversation with than you, because rather than making assumptions, you actually were a dealer. And for years, you actually did this. And so you've seen firsthand what kind of exposures you've had on the books. And so, well, let's tackle this. That's a bad assumption to make, that a dealer's always the seller, right?
For sure. Let's just start with the idea that most clients are naturally long the market, and what they're looking for is a hedge. And so what they do is they buy puts. So that reader is correct that a lot of times what clients are doing is looking to protect their portfolio, and they do that by buying puts. However, often what they do want to do is they don't want to pay too much for that, or they want to sell out of the money calls to basically harvest a yield or a premium for that. So often, like the most popular trade from a traditional money manager to hedge their portfolio is to buy an out of the money call put and to finance it by shorting an out of the money call.
Hence why for most beta 1 kind of stocks, that skew exists, which
Well, no, that skew exists. No, so that's the different story. The skew exists because on the whole, stocks go down faster than they go up.
right.
So the market maker naturally demands more of a premium.
But supply and demand doesn't have to do with that?
Well, so yes, it does also have to do with. You're absolutely correct. So I shouldn't say cut you off completely. But even with even if there was no supply and demand, most market makers would price it like that.
Right.
Because the reality is that on the way down, stocks are much more volatile than on the way up. If you think about it, often we just chug
I'm just
higher,
thinking that
and then we
I'm
and
just
then we
thinking
plummet
that if
lower.
everybody wants to be a covered call writer and harvesting income, and I'm always stuck with the calls on my book, I'm always going to offer lower implieds on out of the money
no,
calls.
you're absolutely right.
And
But not only that, but the actual realized of the market, the realized volatility of the market is such that on typically you get a situation where it goes down much faster than it goes up. And this is why, you'll see a situation where the skew might look more like a smile instead of a half smile on a fixed income.
Yeah.
Because the reality is that in an extreme environment, you get a situation where bonds are bid, so you actually might see the opposite skew. Or let's take gold. Gold has the opposite skew, I believe.
or at least a nice U shape to it.
Yeah, I think gold might have the half smile the other way, meaning that the far out of the money calls on gold are much higher than the far out of the money puts, right? So now, but that is not. So we realize that that's the natural kind of typical flow, but that doesn't have to be the case. Not only that, let's kind of delve into the idea about all these clients recently that have been selling premium to collect a yield. So there's also, or those are, we've talked about the traditional clients that'll go and actually just kind of buy a put, sell a call to pay for it, and boom, there, Bob's your uncle, they let it go. There's also the clients that go out and sell straddles. You remember Option Vault? What was the guy, the natural gas guy?
Optionsellers.com.
Optionsellers.com. He basically was just harvesting premium, so he was always the seller.
Yeah.
So we get a situation in that he was most likely selling it to the dealers. Yeah, he might have been selling to the end clients, but I suspect that the dealers were just buying it. And this is, it's a difficult kind of thing to say. It's always this way. Dealers are always short, or dealers are always long. What you just need to understand is that typically that dealers are often short the out of the money puts because nobody really wants to sell those, and that they're often long the calls because again clients want to sell those. Now,
so let's talk about it from a gamma and delta.
Yeah, because let's
perspective.
go on to the next one because the reader or the listener is kind of implied that market manipulation is happening. And I want to just say there is no market manipulation. Clients do not go sell it out of the money put and then keep the market higher because they want it to not expire in the money. That does not happen.
Yeah.
Like, maybe on the occasional small float stock that'll happen, But the market is a big dynamic place with many, many different players. What we are talking about, though, is the idea that if, let's just say, like people ask, why do things get, if I'm correct, why do stocks get pinned at strikes?
Well,
Like if there's not manipulation going on, why do stocks get pinned at strikes, right?
yeah.
Well, the reason that stocks get pinned at strikes is, let's just say that there's been all sorts of put buying at a certain strike, and it's trading around that strike as we get closer to expiry. What happens is the clients are selling the put to the dealer back, and then when the dealer is going, they have to go and they have to buy they have to they're selling the put, so the dealer's long the put, and now they have to buy a stock against it. So there's a natural tendency for it to go up towards the strike. Same with when clients are selling the long call. So you get a situation where, like, if they're selling the long call, the dealer buys the call and then shorts the stock against it. So as that pressure comes towards expiry, there's a tendency for it to drift towards the strike because of the clients unwinding their positions.
Yes.
And that's the key that people need to realize, is that there's no manipulation going on. It's not like the dealers are going, let's just pin this to here. It's occurring naturally because of the flows.
And there's so many dealers. It's like in order to try to create some sort of an agreement amongst everyone to do something like that, that's like a grand conspiracy.
Yeah. Listen, are there times when a big player can affect an asset class and keep it above it for a strike? For sure. Not only that, like, think about those knock-on stock things when you get a one-touch, meaning that it pays off as soon as it gets touched at a certain level. There's no doubt that people go hunting for those, and they go, oh, let's see if we can get it up there because I can all of a sudden knock that in, right? So there's shit like that does happen. But on the whole, there's not some grand plan to kind of keep them from like holding it up so that these puts or the calls can expire.
Let's move on, and I want to just so we have a chart here from spotgamma.com.
Right.
And it's a very kind of U-shaped, very probability distribution kind of curve. But I want to specifically talk about this idea that they have what's called a high volatility zone and a low volatility zone. And if my interpretation, and you can tell me whether I'm interpreting this right, because on the right side of the chart, which has the low volatility zone, and dealers are generally long calls because they've sold a whole bunch. They are, as the delta is going up, they want to be delta neutral, and which means that they, on balance, have to be selling the market in order to stay flat.
That's correct. They are rises are causing it to be sold.
So what happens is that when you're on the right side of this curve, what's happening is volatility contracts,
right?
Because as buyers are buying, the dealers are selling, and it would therefore reduces the overall volatility market.
Right.
Hence why VIX tends to actually gravitate to the bottom end of the range during rallies.
Right. And so, like, let's go back to this idea: the dealers sell the rally. So they're hedging their delta, their positive gamma, meaning that as it moves, they get longer. But not only that, as it moves down, they get shorter again. Yeah. So let's take, for example, the S&P's up to 10 today. The dealers were selling all that rally because they're long gamma right now. Tomorrow, we open down 10. Guess what they're doing? They're buying everything they sold back today.
Yeah.
And that amount, so they're sitting there trying desperately that they hope the market will move lots. But by being long, they're actually stopping the market, being long gamma, they're stopping the market from moving as much because they're dampening the effect.
Exactly. Lowering the volatility.
That's
correct. They're not changing the trend, they're dampening everything. Things just move less.
That's correct, because they're selling rallies, they're buying dips.
At the same time, the gamma flip is when dealers have all of these puts, and they're actually short the puts.
Right. So, the important thing that people realize is you could be long or short gamma through puts or calls.
Yeah.
But it doesn't really matter if it's a put or call because of put call parity. It doesn't really matter. The question is whether the dealer is long or short the option premium. So at this point, because they've sold all these out of the money puts that become in the money, or are approaching in the money,
They have to sell more.
that's right, because they are no longer long gamma. They are become short gamma. So as it goes down, they become increasingly long, and they, instead of being kind of the opposite, when they were up at the above, they were selling rallies and buying dips. Okay.
Yeah.
When they're short gamma, they have to chase it. They have to sell on the way down, and then they
Yes.
have to chase it
And
back
they
up.
exacerbate this circumstance
Exactly.
by adding selling to selling pressure. Hence why that's the high volatility zone.
Right.
And so, arguing about specific gamma levels may not be, or certain strike prices with high gamma is not as important as knowing where the flip is, because the flip creates where the high volatility. So right now on the S&P 500, the high volatility zone is, at least according to spot gamma guys, it's below 3,050. And so really any, let's say 30 or 40 or 50 point drop in the S&P doesn't mean anything. But if we have a 100-point drop and we start getting into the zone, suddenly the dealers are actually selling futures, exacerbating the selling pressure.
Right. Now, the one caveat I'll give you about all these charts, you actually don't know.
They're dynamically.
Well, no, you don't know if the dealer actually sold all those. So when I was on the desk, we would sit there, we'd make markets, but all of a sudden, let's just say someone asked me for an out of the money puts. I say, okay, let's say 12 vol bid, I'm 14 vol offer. They say, fine, bought from you. I buy, $5 million at 14 vol. I think I'm short. Then all of a sudden, I have a situation where a client comes in and says, hey, look, I'm actually looking to do a put right or whatever, and I'll sell those. And so the trade gets taken over by a client. So these things, all these charts and all of these graphs are assuming that the dealer
They
took
know
all
the
of it.
dealer exposure.
So you don't really know, because think about, let's go back to my example. If I sell that as a dealer and it goes down there, I am dynamically hedging.
Yeah.
If a Canadian pension plan sells it, they aren't dynamically hedging. Comes down there, if it finishes in the money, they'll
just take it on the position.
Yeah. So
Yeah.
it really, and this is the one thing that people need to realize, is that the counterparty to the transaction is what makes it either more or less volatile.
Yeah.
And it has to do with the fact that dealers do not want that risk, and dealers therefore will dynamically delta hedge it. But if you have an underlying real client that takes the other side, then all of those charts are wrong.
Yeah.
So it's not quite as easy as everybody, like they make these charts out like that they're set in stone and they know for sure that this is the case. They are very, very rough approximations of what's happening.
Yeah.
Just remember that, because they're not perfect by any means.
Yeah.
And so you never know if a client took another side, or if there's a over-the-counter option that we don't know exists. It was just some things to keep in mind. But I agree with you that the important thing to realize is that dealers, when they're short gamma, it means that they're chasing the market down or up. And when they're long gamma, they are doing the opposite. They are selling rallies, buying dips, and their behavior causes the market to either be more or less volatile.
Yeah, there you go.
There you go.
All right.
My
well,
opinion.
that was the Q&A, Kev.
Yeah, that's it. Our first one.
There you go. Okay, so time to wrap up the show.
Okay, this is the point where our main show ends, but those who want more Market Huddle, stick around for the after hours interview.
All right, so very quickly, some announcements. Hopefully, many of you had the opportunity to listen to this earlier, but I'm going to be out on the west coast of Canada, and I'm going to be doing the Options Education Days Saturday, November 30th in Vancouver, Sunday, December 1st in Calgary. Tickets are still available to attend, so you go to the Montreal Exchange website to grab those. But Kevin, I can't possibly go out there without doing a Market Huddle meetup. So on Friday, at 7 p.m. I'm going to be at the Fairmont Pacific Rim Hotel Bar down there. Any one of our listeners that want to come out, no RSVP needed for the meetup. Just come out and have a beer. Just say hello and just tell us what you think and give us some questions that you want answered in the future. As well, after the Options Education Day in Calgary on the Sunday, I'm going to be at the Calgary at the Westin Hotel there in Calgary at the bar after 5 p.m. after the show ends, having some drinks. So any of our listeners that want to come and meet up and say hello there, it's on the Sunday, and so hopefully we'll get an opportunity to meet many of you. Looking forward to it.
Just a reminder that Market Huddle is available on iTunes, Android Play, Podbean, Spotify, and YouTube. To our American friends, have a great Thanksgiving. For everyone else, have a great weekend. Thanks for listening. We appreciate you taking time to join us and look forward to hopefully speaking again next week. I'm Kevin Muir.
And I'm Patrick Seresna. Have a great weekend.